I want to start by telling you something that very few people in this business are willing to say out loud right now. I am scared. Not the kind of scared that makes you freeze. The kind of scared that makes every single instinct you have developed over 5 decades of reading markets fire at the same time. The kind of scared that, in my experience, only shows up 3 or 4 times in an entire career. And the last time I felt it this acutely, this specifically, this deeply rooted in actual data and actual structural dynamics rather than just nerves or noise was 2007. And you know what happened after 2007? What I am watching China do right now, the moves they are making, the signals they are sending, the economic architecture they are quietly dismantling and rebuilding in a completely different direction. It is triggering something in me that I cannot ignore, and I will not insult your intelligence by pretending otherwise. So let us talk about what is actually happening because I think you deserve the unvarnished truth, even when the unvarnished truth is deeply uncomfortable. Let me take you back to something I have said for years because it is the foundation of everything I'm going to walk you through today. The single most important variable in global markets is not earnings. It is not Federal Reserve policy. It is not even interest rates in isolation. It is liquidity. Where is the liquidity in the global system? Which direction is it flowing? Is it expanding or contracting? And who controls the spigot? For 30 years, the answer to that question was simple. The United States controlled the spigot. The dollar was the world's reserve currency. American capital markets were the deepest and most liquid on earth. And when America sneezed, the rest of the world caught a cold. That framework shaped every macro trade I made from the 1980s through the 2000s. And it was right until it started being wrong. And what China is doing right now is the most aggressive, most deliberate, most structurally consequential challenge to that framework that I have seen in my lifetime. And the market is not even close to pricing it. So what exactly is China doing? Let me be very specific because I think the mainstream financial media has been covering this story in a way that completely misses the magnitude of what is happening. On the surface, you see the trade war narrative, tariffs, counter-tariffs, export controls, diplomatic tensions. And yes, all of that is real and all of that matters. But that is the visible part of a much larger iceberg. What is happening beneath the surface is a systematic, multi-year, carefully orchestrated campaign by China to reduce its vulnerability to the dollar-based financial system. Think about what that actually means. China holds trillions of dollars in U.S. Treasury securities. For decades, that made strategic sense. You park your export earnings in the safest, most liquid asset in the world. You earn a modest return and you maintain good standing in the global financial system that your export economy depends on. That was the logic. But after watching what happened to Russia, after watching the United States freeze Russian central bank reserves almost overnight, Xi Jinping and the people around him made a decision, a very cold, very calculated, very consequential decision. They decided that dollar reserves are not an asset. They are a liability. They are a hostage. And they began quietly but systematically to reduce that exposure and replace it with something that cannot be frozen, cannot be sanctioned, cannot be weaponized against them. And what they replaced it with is gold, bilateral currency agreements, and a parallel financial infrastructure that is slowly but unmistakably being built to function independently of the dollar system entirely. Now, I want you to sit with that for a moment because I think the full implications take a few seconds to land properly. China is the second largest economy on Earth. It is the largest trading nation on Earth. It is the largest holder of U.S. Treasury securities among foreign nations, and it has made a strategic decision at the highest levels of government to reduce its dependence on the dollar. When an entity of that size and that strategic intentionality begins moving in a direction, the gravitational effects on everything around it are enormous. And those effects do not show up all at once. They accumulate slowly, then they tip, and then they happen very fast. I have watched this pattern play out in currency markets, in credit markets, in equity markets more times than I can count. The slow accumulation of imbalance followed by the sudden violent resolution. And every single time, the majority of market participants are shocked by it. Even though, in retrospect, the signs were everywhere, let me talk about the specific data points that are worrying me most right now because I want to ground this in something you can verify independently. Chinese central bank gold purchases have been running at levels not seen in modern history. Month after month, quarter after quarter, the People's Bank of China has been adding gold to its reserves at a pace that is genuinely extraordinary. And here is the critical thing about that. Gold purchases by a central bank of that size are not a tactical trade. They are not betting on gold going up 20% next year. They are a strategic repositioning of the national balance sheet. They are saying we want our reserves in an asset that exists outside of any other sovereign's control. That is a profound statement about where they think the world is going. And when the largest creditor nation on earth is making that statement with its actual balance sheet decisions, I think every investor in the world should be paying extremely close attention. The second data point is the Yuan internationalization push. China has been aggressively expanding the use of the Yuan in bilateral trade, the petro agreements with Saudi Arabia and other Gulf states, the Yuan-denominated commodity contracts on the Shanghai Exchange, the bilateral currency swap lines with dozens of countries across Asia, Africa, and Latin America. Individually, you can look at any one of these and say it is small. It is incremental. It does not threaten the dollar today. And you would be right. None of them threatens the dollar today. But the question I always ask, the question that George Soros taught me to ask, is not what is happening today. The question is, what is the direction of travel, and where does that direction lead if it continues for 5 more years? And the direction of travel on Yuan internationalization is unmistakably toward a world where a significantly larger portion of global trade is settled in Yuan, where a significantly larger portion of global reserves are held in Yuan and gold rather than dollars, and where the structural bid for U.S. Treasury securities that has kept American borrowing costs artificially low for decades is meaningfully diminished. When that bid weakens, and it is already weakening, the implications for American interest rates, for the American fiscal position, for the real value of dollar-denominated assets are severe in a way that the market has not begun to discount. The third thing I am watching, and this one is the most immediately dangerous in terms of market impact in 2026, is what is happening inside the Chinese domestic economy and how it is interacting with the global financial system. China is sitting on a deflationary time bomb that they have been trying to defuse for 3 years and have not succeeded in defusing. The property sector, which at its peak accounted for roughly a quarter of Chinese GDP and an even larger share of Chinese household wealth, is in a slow-motion collapse that the government has been trying to manage through intervention, through credit support, through liquidity injections, through every tool in the policy toolkit, and none of it has worked in a sustainable way. Property prices in major Chinese cities are still falling. Developer balance sheets are still impaired. Local government finances, which were deeply dependent on land sales as a revenue source, are under severe stress. And household confidence, which is the foundation of any consumption-led recovery, is damaged in a way that takes years to repair. This is not a Chinese problem that stays in China. China is so deeply integrated into global supply chains, so critical to global commodity demand, so interconnected with the financial systems of Europe and Asia and emerging markets, that a sustained deflationary contraction in China exports deflation and instability to the entire global economy. And that is exactly what I think we are beginning to see. I want to connect these threads now because I think individually each of them is concerning, but the way they interact with each other is where the real danger lies. You have China strategically reducing its holding of U.S. treasuries at exactly the same time that the United States government has the largest peacetime fiscal deficit in its history and needs to issue enormous quantities of new debt to fund it. Think about the supply and demand dynamic there. Supply of U.S. Treasury securities is going up dramatically. One of the largest sources of demand for U.S. Treasury securities is going down deliberately. Basic economics tells you what happens in that situation. Yields go up, and when Treasury yields go up, everything that is priced off the risk-free rate gets repriced. Equities, corporate bonds, real estate, private equity, everything. This is not a complicated chain of logic. It is a straightforward supply and demand analysis applied to the most important market in the world, and the answer it gives you is not comforting. Now, layer on top of that what is happening with the U.S. economy domestically, because I do not want you to think this is purely a China story. The vulnerabilities in the American financial system that China's actions are going to expose are vulnerabilities that Americans built themselves over a decade of zero policy and fiscal excess. Corporate America gorged on cheap debt during the zero-rate era. The total non-financial corporate debt in the United States is at levels that are genuinely historic relative to GDP, and a significant portion of that debt was issued at interest rates that no longer exist. Refinancing risk is something I've been talking about for 2 years, and I'm going to keep talking about it because I do not think the market has fully absorbed what it means when trillions of dollars of corporate debt rolls over in a higher rate environment. The companies that can absorb higher refinancing costs will survive. The ones that cannot will not. And the process of separating the survivors from the non-S survivors is not a gentle, orderly process. It is messy and it is contagious, and it tends to happen much faster than anyone expects once it starts. Let me tell you about a specific type of company that I think is going to be at the epicenter of what is coming. It is not the headline mega cap technology names that everyone is focused on. It is the middle tier. The companies that are large enough to have taken on significant debt, but not large enough to have the balance sheet strength or the free cash flow generation to absorb the kind of interest expense shock that is coming. These are the companies that issued leveraged buyout debt at 4 and 5% that is now going to roll over at 8 and 9%. These are the companies in sectors like commercial, real estate, retail, media, health care services that are facing simultaneous pressure from slowing revenue growth and exploding debt service costs. When those two forces meet in the same company at the same time, the outcome is predictable and it is not pretty. And I think you are going to see a wave of distress in this middle tier of corporate America. That is going to be the credit event that finally forces the equity market to confront the reality it has been avoiding. I want to talk about the Federal Reserve in this context because I think their position right now is the most constrained it has been since the 1970s, and I do not think the market fully appreciates that constraint. The traditional Fed playbook when the economy slows and markets crack is to cut rates aggressively and flood the system with liquidity. That is what they did in 2001. That is what they did in 2008. That is what they did in 2020, and every time they did it, it worked. It stopped the bleeding. It reflated asset prices. It bought enough time for the economy to recover. Investors have been conditioned by 25 years of this pattern to believe that the Fed put is always there, that no matter how bad things get, the Fed will step in and save the market. And that conditioning has created a complacency that I think is one of the most dangerous elements of the current setup, because the Fed's ability to run that playbook depends on inflation being under control, and inflation is not under control, not in any durable structural sense. The headline numbers have come down from their peak, but the underlying forces that drove inflation, the deglobalization, the energy transition, the labor market structural shifts, the fiscal deficits that are essentially permanent features of the American political landscape. Now, those forces are still present and they are still inflationary. And if the Fed cuts rates aggressively into a slowing economy, they risk reigniting inflation in a way that destroys whatever credibility they have managed to rebuild since 2021. They are caught. They cannot run the old playbook freely anymore. And a market that has been priced on the assumption that the old playbook is always available is going to have a very rude awakening when it discovers that it is not. George Soros used to talk about reflexivity, the idea that market prices do not just reflect reality, they actively shape reality. They feed back into the underlying fundamentals in ways that create self-reinforcing cycles of boom and bust. And I think you are going to see reflexivity work in a particularly vicious way in 2026. Here is the mechanism I am most worried about as credit stress begins to appear. As some of these over-leveraged companies begin to show the strain of refinancing in a higher rate environment, credit spreads begin to widen. As spreads widen, the cost of capital goes up for the entire corporate sector, not just the stress companies. As the cost of capital goes up, investment slows, hiring slows, consumer confidence softens. As consumer confidence softens, revenue growth disappoints for companies that were priced for continued robust growth. As revenue disappoints, earnings misestimates. As earnings misestimates, the equity market reprices. And as the equity market reprices, the wealth effect that has been supporting consumer spending reverses, which slows the economy further, which causes more credit stress. This is the doom loop. I have watched it play out in various forms multiple times. And the starting gun for this particular version of it, I believe, is China's continued deliberate pressure on the dollar system combined with the structural fragilities that already exist in American credit markets. Let me tell you what I am actually doing about this, because I think the most useful thing I can give you is not just analysis, but the shape of how I am positioning. I am not all in short on America. That is not the trade, and it is never the trade. I am building asymmetric positions. I am long volatility in specific ways. I am long gold and have been increasing that position consistently. I am short credit, specifically in the sectors I described, the over-leveraged middle tier, where refinancing risk is most acute. I am long the dollar in specific cross rates because, paradoxically, when global risk appetite collapses, the initial move is almost always into dollars as the safest liquid asset, even when the long-term trend for the dollar is negative. Knowing the difference between the short-term panic trade and the long-term structural trade and being positioned for both is part of what I mean when I talk about asymmetric positioning. And I am holding more cash than I normally would, because cash in an environment like this is not a zero return asset. Cash is optionality. It is the ability to buy things at prices that do not exist today when the dislocation comes. I also want to talk about what I am watching for as the signal that the next phase is beginning, because I think timing in a situation like this matters enormously. The first signal I'm watching is the credit default swap market, specifically investment-grade CDS spreads. When those start moving meaningfully, when the cost of insuring against default on high-quality corporate debt starts rising in a way that is not explained by just the macro rate environment, that tells you that sophisticated credit investors are getting nervous about something specific, and it is worth paying very close attention to what they are nervous about. The second signal is the Treasury market, specifically what happens at Treasury auctions. If you start seeing weak demand at Treasury auctions, if the bid-to-cover ratios start declining, if the foreign participation starts dropping off, that is the China thesis playing out in real time in the most important market in the world. And the third signal, and this is the one that will tell me the move is imminent rather than just building, is the currency market, specifically the yen and the yuan. The yen, because Japan is the largest foreign holder of U.S. Treasuries, and any significant move by Japan to reduce that holding would be seismic in the yuan, because if China decides to let the yuan depreciate meaningfully against the dollar, which is one of the tools they have available in this economic confrontation, the deflationary wave that sends through the global economy is enormous, and it lands in American corporate earnings with particular force. Now, I want to spend a few minutes on something that I think is critically important and almost never gets discussed in the context of China and markets, and that is the technology dimension of this confrontation. Because what is happening between the United States and China is not fundamentally a trade dispute. It is a technology war, and the stakes of that technology war for financial markets are larger than most people realize. The United States has placed export controls on advanced semiconductors and chip-making equipment in an attempt to slow Chinese progress in artificial intelligence and advanced computing. China has responded with its own export controls on rare earth minerals and critical materials that are essential inputs for American technology manufacturing. Both sides are trying to weaponize the interdependencies that decades of globalization created, and the result is a force to globalization of the technology supply chain that is going to be enormously expensive, enormously disruptive, and enormously inflationary for both economies. The cost of rebuilding semiconductor supply chains domestically in the United States is measured in the hundreds of billions of dollars and takes decades to fully execute. The cost to China of developing domestic alternatives to American software and chip technology is similarly enormous. These are not costs that disappear. They are costs that flow through to corporate margins, to government budgets, to consumer prices, and they are permanent features of the landscape now, not temporary disruptions that resolve when diplomatic relations improve. I want to address the bull case because intellectual honesty requires me to do that. The bull case says that China is too rational to let this confrontation spiral into something that genuinely destabilizes global markets because China's export-dependent economy needs a stable global financial system as much as anyone. The bull case says that the Fed has more room to maneuver than I am giving them credit for, that inflation will continue to moderate and they will be able to cut meaningfully if growth slows without reigniting price pressures. The bull case says that the American economy has proven its resilience repeatedly and that the consumer and the labor market will absorb the shocks better than pessimists expect. I hear all of those arguments and I take them seriously. This is not a situation where I am certain about the outcome. I am never certain. In 50 years of doing this, I have learned that certainty is the most dangerous emotion an investor can feel. What I am saying is that the probability distribution of outcomes has shifted materially toward the downside, that the market is not pricing that shift appropriately, and that the asymmetric trade, the trade where being right is enormously profitable and being wrong costs you a defined and manageable amount, is clearly on the bearish side of this setup. Let me also say something about China that I think is important for your understanding of how serious they are about this confrontation. Side gimping is not making economic decisions the way a Western leader makes economic decisions. He is not primarily concerned with quarterly growth numbers or stock market performance or consumer confidence polls. He is operating on a decades-long strategic timeline with a very specific vision of where China should be in the global order by 2049, which is the centenary of the People's Republic. That vision involves China being the dominant power in Asia and a peer competitor globally to the United States across every dimension: military, economic, technological, and financial. Every policy decision he makes, including the economic ones that look puzzling or self-defeating from a short-term Western analytical framework, needs to be understood in that context. He is willing to accept short-term economic pain in China if it advances the long-term strategic objective of reducing Chinese vulnerability to American financial power. That willingness to accept pain, to play a longer game than any democratic politician can play, is something that Western markets consistently underestimate and underappreciate. And it makes China a more dangerous and more formidable adversary in this confrontation than the consensus view suggests. I want to come back to something personal for a moment because I think context matters. I have spent my entire career being told that my concerns were overblown. In 1999, I was told the technology boom would last forever and that valuation did not matter in the new economy. In 2006, I was told that housing prices could not fall nationally, that the financial system had distributed risk so efficiently through securitization that a systemic crisis was impossible. In both cases, the people who told me those things were smart, well-credentialed, genuinely knowledgeable people who had very good reasons for their optimism. And in both cases, they were catastrophically wrong. Not because they lacked intelligence, but because they were anchored to a framework that the world was in the process of leaving behind. The world was changing, and they were analyzing the new world with the tools of the old one. I feel the same dissonance today. The analytical framework that most market participants are using, the one built on 30 years of dollar dominance, Fed omnipotence, and globalization as a permanent feature of the economic landscape, that framework is being rendered obsolete by exactly the forces I have been describing today. And the investors who recognize that first and adapt their thinking accordingly are going to be on the right side of the most significant macro shift of the next decade. So let me give you the complete picture of how I think about 2026 specifically. I think the first half of 2026 is when the credit stress I have been describing becomes visible enough to be undeniable. Not necessarily a crash, not necessarily a lemon moment, but a series of high-profile corporate distress events in the sectors I identified that force the credit market to reprick risk broadly. I think that repricing in credit then begins to flow through to equities in the second and third quarter, initially through multiple compression in the most expensive parts of the market. The growth stocks, the momentum names, the anything but value trades that have dominated the last 3 years. And I think the catalyst that turns an orderly repricing into something more disorderly is a combination of a weak Treasury auction and a currency event, either a meaningful Yuan devaluation or a significant dollar strengthening episode that creates stress in emerging market dollar debt. Those two things happening simultaneously, a crack in the Treasury market and a currency shock, is the combination that historically has produced the kind of rapid, disorderly deleveraging that we associate with a real crash rather than just a correction. Now, I want to be honest with you about the uncertainty here because I think intellectual honesty is worth more to you than false precision. I do not know if this plays out in the first half of 2026 or the second half. I do not know if the severity is 30% or 50%. I do not know with certainty that China will be the approximate trigger rather than something else entirely that I am not seeing clearly right now. What I know is that the structural vulnerabilities are real, that they are larger than they were in 2007 in several important dimensions, and that the market is priced as if they do not exist. That combination, large structural vulnerability plus complacent pricing, is what creates the conditions for a crash.